Hey guys, stick with me into the end of this video and I'll show you all the top AI powered stocks that are still cheap. All right, so our first cheap AI powered stock is TSMC, Taiwan Semiconductor Manufacturing Company. They build out 90% of the world's AI chips, and I just wanted to demonstrate a really important graph to you here, which is their operating margin. Now, keep in mind this is a manufacturing company. You can see they're in the 49 to 50% range. Go ahead, take a second, bust out a quick Google search, take a look at manufacturing companies' operating margins, and you're in for a shock. Ooh, boy, does TSMC make some money? ESM has a profound geopolitical risk in the sense that, they are a territory of China and they do make 90% of the world's most advanced chips that are going to be utilized in artificial intelligence. So you can see that, within the AI arms race here between the US and China, how important TSM is, and that this geopolitical risk surrounding them with a chance of invasion of China could, you know, I believe is fully factored into the price, and that's why we're talking about it here today. Is because you're looking at this company, and I'll get just evaluation metrics later. But I mean, there's unbelievably strong fundamentals, but the price is suppressed because of this geopolitical risk. But I'd also like to take the time to point out that they have a profound operational advantage. They have multi-year technology. Which lets them become the sole manufacturer capable of producing the most powerful chips for innovators like Apple, like Nvidia. They hold over 90% of the market share. They are critical to the global infrastructure. TSM has been able to increase its high performance computing revenue pretty substantially from 2019 through 2025, almost nearly you can see here, almost a 40% compounded annual growth rate year over year when you smooth that out. And management only expects the growth rate to continue over the next 5 years. So when we keep this in mind, when we look at the EV to EBITDA ratio, and keep in mind, is this price too cheap right now? Is now the time to buy in? Here's an excerpt from Baron Global on TSMC. You can see here it's their biggest position in ad during the quarter, and they still believe that the near-term uncertainty with tariffs and this one-to-one chip implemented by Trump, their manufacturing competitive position and leading edge technology still remains unmatched. And I love this quote. It's the ultimate arms dealer to AI. I mean, who doesn't want the ultimate arms dealer in the growth of the AI era? So what else are people saying about TSM? We could take a look at Jensen Huang. Many would say his company, NVIDIA, is at the forefront and the purest AI play there is next to Palantir. What's interesting is what Jensen Huang said. At a press conference talking about TSM, they are a world-class foundry and support customers of diverse needs. You can't overstate the magic that is TSMC. I mean, if that's not a vote of confidence from someone who works directly and the person TSMC supplying the chips to NVIDIA, I mean, I'm a buyer. People are trying to break away from the supplier of Taiwan because they don't want this concentration risk in a supplier. So China started to rely on companies like Huawei to take over the control of chips and, kind of lessen that geopolitical risk of that Taiwanese conflict from a supply chain perspective. But what's interesting is also think of the USA. You've seen the Intel deals and so forth, but Trump really is making an effort to push for every international chip that's bought to one domestic chip purchase too. So he asked TSMC, build a factory in the US, and that's how we can get our domestic chip quota. But Taiwan, TSMC isn't playing ball. They told Trump they're not going to do that. So it makes you think, now is there elevated levels of geopolitical risk due to the situation here that they're not really playing ball with the U.S. So will the U.S. protect them in invade if China decides to invade them? It probably is an increased risk now because they don't want to play ball. So it's interesting, and you can see it too in the stock price and in the multiples. Because going back, do you really think a EV to EBITDA of 12 times is deserving for a company growing at 40% CAGR? I mean, it's ridiculously cheap, and that's because of these geopolitical events. regardless of what happens, I still think they have the strongest backbone and they make the best chips and they supply 90% of the whole market. Nothing's going to change. I'm in it and I'm a buyer for the long run. Next on the list here is Amazon. And in the fact that they've been up less than 40% in the last 5 years here is pretty baffling. They're definitely undervalued for the long run, in my opinion. They're the number one leader in AWS, number one in e-commerce, number three advertising giant and growing. And they have one of the most, if not the most subscribed platforms being Prime. With such a suppressed stock price, you would think that the business is underperforming. But if we just look into one of its segments, for example, AWS, you can see that they're forecasting year-over-year growth that, passes historical. I mean, in constant currency terms, from September of 23 to September of 2026 here, they're at 17% and bolstering, moving up to almost 25%. Quite an increase showing demand, which doesn't really correlate with the decrease in stock price. So AWS is going to have higher projected periods than it had in 2023, yet its stock is trading abysmally above 2023 levels when compared to other Mag 7 stocks. So let's compare it against some of the competition, right? Maybe there's some insight we can get looking at competitors. So we have AWS, Azure, and Google Cloud here, blue, orange, green. And you can see AWS is far head and shoulders above all the next competition here quite significantly. Makes you think, why is the stock acting so flat if this is the Sankit service we're looking at, growing year over year and outperforming in backlog in terms of their competition? So let's just take a step back for Sankit and take a look at total revenue. And it's interesting because you can see since 2014, Walmart has been top dog in the United States in terms of revenue, bringing in the most revenue. And you can see this changing over time with the blue line being Amazon, slowly creeping up here until 2025, where they're still edged out slightly by Walmart, but the 2026 forecast predicts Amazon as the new top dog in terms of revenue. Hey, forget what I think about it. Let's look at Congress. They have some elite traders in there, if you know what I mean, Nancy Pelosi. Congress's biggest buys in the last 3 months. Number three down here being Amazon. Now I see people freaking out. The margins are plummeting, Mark. Oh my God, relax. Just take a minute, look at the financials, and you'll see the decrease that you see in the operating margins right here, from 39.5 to 32.9% in 1 quarter, right? Whoa, my God. But just take a second and look at the operating expenses and, map this out right next to it. You'll see depreciation is the reason for that, right? Depreciation from the build out of capital expenditures because of the anticipated AI move. Yes, margins are going to be compressed, but what's more important to me is that they're making the capital expenditures necessary to be a player in the future. And we were talking about this earlier with Walmart and Amazon's revenues. You can see here in the projection period 25 through 2029, they're at 700 billion and expected to pass just about a trillion in revenue by 2029. So what's my point? We see the growth rates, we see the outperformance when compared to other companies, and we see the flatline trend in the stock price. What's interesting is if you map their EV to EBITDA ratio right here over the last 10 years from 2015 to 2024, they're at their lowest point yet. I mean, we're on the cusp of robotics. They're on the cusp of improving all of their operating margins when they get the robotics down. It's a great buying opportunity right now. I mean, who wouldn't be buying? So next up on the list here is NVIDIA. And I chose NVIDIA for a couple reasons that we'll get to in this slideshow. But first, I wanted to point out is they're still on track of the Mag 7 for the highest ranked revenue next year at 33% increase compared to everybody else, blowing them out of the water. Now use this same slide if you're smart. I already saw this slide, but just to point out again, Amazon was three, but look who number one is. Nvidia in Congress's biggest buys in the last 3 months. Another cool tidbit, I've pointed this out before, but founder-led companies outperform the rest. There's a Harvard Business Review study you can Google on this, and it will show that founder-led tend to outperform the family of non-founder-led companies. And with Jensen Huang being the founder and still the leader of NVIDIA, it gives me higher hopes and conviction in the stock. NVIDIA gets 6% of its total revenue from China. It's a very important market to NVIDIA, and I wanted to highlight this because of these export restrictions could complicate things for NVIDIA and their relationships with China. And I wanted to highlight here, if you look, I have NVIDIA broken down here by revenue by region, the growth rate by region, little bubble chart. The bigger the bubble, the bigger representative portion of their revenue. So now just looking real quick at their revenue, look at China's proportion. They were committing 5 billion a quarter, just about 20 billion annually a year, and you see this 24% decrease, and now they're only committing 2.8 billion a year. Eventually, Nvidia's going to have to figure out either we need to start and replace our 6% of total revenue coming from China with somewhere else, or we need to find a way around these restrictions. But this is definitely some pressure right now with Nvidia and something management needs to figure out going forward. I feel like this is often overlooked by investors, but when you're valuing a company, there's a thought, right, that you pay one business for the cash flows, and then there's excess assets. An excess asset could be a building. Think about McDonald's. You can pay for the revenues that McDonald's, the corporation, generates, but McDonald's owns the land in the building. So you can buy a McDonald's franchise, but not own the building. So it's kind of like this thought, right, that you pay one price for the business, one price for the excess assets. And excess assets also, as you know, in the calculation of enterprise value, accounts for cash and short-term and long-term investments. Well, this is the part I'm saying that it's overlooked. Think about NVIDIA's stock portfolio and think about the deep inside knowledge that Mr. Huang has into AI and into some of these companies. And also think about the reaction he in turn generates when he announces through his 13F that, oh, we're going to buy CoreWeave. And then everyone and their mother decides to buy CoreWeave and jumps up 50%. He has a $4.3 billion portfolio value, which is peanuts compared to the overall valuation. But these things are marked at cost, marked at what he bought them at. These things are not updated on the regular. So not only are you getting access to all of NVIDIA, you're also getting access to their investment portfolio holdings, which he has stellar returns on. Man, I hope you made, if you made it to one slide, I hope you made it to this one. Unfortunately, it's the last one, but just wanted to bring in big picture conclusion. I hear people argue Nvidia is overpriced. It's been growing, there's no room left. There's nothing left for investors. All the returns been eaten up. Oh, on the contrary. If you take a look at Nvidia here, I've spread their valuation metrics. Just look at price to earnings. That's, everyone looks at price to earnings. Not my favorite metric to use, but I believe it's the most used metric by investors, which gives us good insight. So when I compare it to two companies, I want to compare it to Walmart and Costco. In my eyes, Walmart and Costco command a very high premium and continue to carry such a high premium on their price to earnings metric. I don't have them attached in this slideshow, but I have it written down here. Walmart has a PE of 36.85 and Costco has a PE of 45.59, and you can check that on me right now. But look at our price to earnings ratio of 32. So even in perspective to Walmart, we're 4 notches under Walmart and 13 notches under Costco. But putting it into perspective, you pay a higher multiple for things that grow faster. Nvidia, if you go back to a couple slides when I showed that graph of them increasing, they're blowing these guys out of the water. They're not Walmart and Costco aren't growing at 43, 50% a year. But Nvidia is still only commanding a 32 times multiple compared to Costco's nearly 46 times multiple, and it's growing a third of as fast as Costco. I mean, Nvidia is still a lot of time to buy, in my opinion. Still not near overbought. Once I see it crossing well above Costco's PE multiple, that's when I'm going to start to back off. All right, guys, that was it. Hopefully, you got something out of this. Till next time.